Have you ever wondered how the rich keep getting richer while their money seems to work for them? The secret isn't luck, it's investing. But where do you even begin? Don't worry, because in today's video, we're breaking down Investing 101, a beginner's guide to growing your wealth. Whether you have $100 or $10,000, this video will help you take the first step toward financial freedom. So grab a notepad, hit that like button, and let's dive in. Understanding why investing matters. Investing is a crucial financial strategy that allows individuals to grow their money by putting it to work in different assets. Unlike saving, where money remains idle and earns minimal interest in a bank account, investing provides an opportunity for higher returns by leveraging financial markets. By allocating funds into investments like stocks, bonds, real estate, or mutual funds, investors can achieve financial growth and security over time. The power of compounding. One of the key reasons investing is so effective is the power of compounding. Compounding occurs when the earnings from an investment generate additional earnings over time. This means that not only does your initial investment grow, but the returns on that investment also grow, creating a snowball effect. For example, if you invest $1,000 and it earns 10% annually, after the first year, you'll have $1,100. Instead of withdrawing that extra $100, you reinvest it, and in the second year, your return is based on $1,100 rather than $1,000. Over decades, this cycle can significantly increase wealth. The earlier you start investing, the more you can benefit from compounding. What are stocks? Stocks are among the most well-known investment options. When you buy a stock, you purchase a small share or equity in a company. Stocks represent ownership in a business, and their value can fluctuate based on the company's performance, market conditions, and investor sentiment. How do stocks generate returns? Capital appreciation. If a company grows and becomes more profitable, its stock price generally rises. For example, if you buy a stock at $50 per share and it increases to $75, you have a $25 gain per share. Dividends. Some companies distribute profits to shareholders in the form of dividends. These payments provide investors with a steady income in addition to potential price appreciation. Stock market volatility. While stocks have historically provided strong returns over the long term, they can also be volatile. Stock prices can rise or fall dramatically based on economic conditions, company earnings reports, and global events. Because of this, investing in stocks requires a long-term perspective and the ability to tolerate market fluctuations. Exploring bonds as a safer option. For investors seeking a safer, more stable investment, bonds are a popular choice. A bond is essentially a loan made by an investor to a government or corporation. In return, the issuer agrees to pay periodic interest and repay the principal amount at maturity. Types of bonds. Government bonds. Issued by national governments, these are considered very safe investments. U.S. Treasury bonds, for example, are backed by the federal government and offer steady, though lower, returns. Corporate bonds. Issued by companies to raise capital, these tend to offer higher interest rates than government bonds but carry more risk. Municipal bonds. Issued by state or local governments, these bonds often come with tax advantages for investors. Bonds are attractive to conservative investors because they provide fixed interest payments and are generally less volatile than stocks. However, they also offer lower returns, making them best suited for risk-averse investors or those nearing retirement. The basics of mutual funds. Mutual funds allow investors to pool their money together and invest in a diversified portfolio of stocks, bonds, or other assets. Managed by professional fund managers, mutual funds provide investors with an easy way to gain broad market exposure without having to select individual stocks or bonds. Types of mutual funds. Equity funds invest primarily in stocks and aim for high growth. Bond funds focus on fixed income securities and provide steady returns. Balanced funds combine stocks and bonds to balance risk and return. Index funds track a specific market index, such as the S&P 500, offering low fees and broad diversification. Mutual funds are a great option for beginners because they reduce risk through diversification and require little effort to manage. Setting investment goals. Before investing, it's essential to define your financial goals. Your investment strategy should align with your objectives, whether they are short-term or long-term. Short-term goals, 1 to 5 years. Saving for a vacation. Building an emergency fund, saving for a home down payment. Best suited for high-yield savings accounts, bonds, or conservative mutual funds. Long-term goals, 5+ years. Retirement planning, funding a child's education. Wealth accumulation. Best suited for stocks, growth-oriented mutual funds, real estate investments. Your risk tolerance also plays a crucial role in shaping your investment strategy. Those comfortable with high risk may opt for more aggressive investments like stocks, while risk-averse investors may prioritize bonds and dividend stocks. Diversification, reducing risk in your portfolio. Diversification is a strategy that spreads investments across different asset classes to reduce risk. By holding a mix of stocks, bonds, real estate, and other investments, you can protect your portfolio from severe losses. For example, during a stock market downturn, bonds may remain stable, helping to balance overall returns. Investing in different industries and geographic regions also enhances diversification, reducing the impact of poor performance in one area. Investing through index funds. Index funds are a great option for investors seeking steady, low-cost growth. These funds track a specific market index, such as the S&P 500 or NASDAQ Composite, and aim to match its performance. Benefits of index funds: low fees. Passive management keeps costs low. Diversification. Exposure to hundreds of stocks in a single investment. Consistent returns. Historically, index funds have provided reliable long-term growth. Warren Buffett, one of the world's most successful investors, recommends index funds as a simple and effective investment strategy for the average person. Starting your investment journey. Investing may seem intimidating at first, but by following a few basic steps, anyone can begin growing their wealth. Educate yourself. Learn about different investment options and how they work. Set clear goals. Define what you want to achieve with your investments. Assess your risk tolerance. Determine how much risk you're comfortable taking. Diversify your portfolio. Spread investments across multiple asset classes. Start small. Begin with a manageable amount and increase investments over time. Stay consistent. Regular contributions and patience lead to long-term success. And there you have it, your beginner's guide to investing. Remember, investing isn't about getting rich overnight. It's about consistency, patience, and smart decisions. So, which investment strategy are you most excited to try? Stocks, index funds, real estate? Let me know in the comments below. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you never miss out on future financial tips.